Michael Roberts is, I think, very well known to lots and lots of people. He's, I would say, one of the star economist bloggers from the left. Michael has worked as an economist in the City of London for various financial institutions for over 40 years. In the heart of the beast, as he likes to say. He has written several books, including The Great Recession, a Marxist view, which was about the 2009 crisis, which I like to call anyway, the North Atlantic financial crisis, not the global financial crisis. The Long Depression, which was published in 2016. He jointly edited The World in Crisis in 2018. Marx 200 was an authored book in 2018, and Engels at 200 in 2020. He is joint author with Guglielmo Carcedi of a forthcoming book to be published by Pluto Press called Capitalism in the 21st Century Through the Prism of Value. And as you know, his blog is called The Next Recession, thenextrecession.wordpress.com. So Michael, please go ahead.
Well, thank you, Radhika. Good to be here. I'm going to make some similar sorts of comments that Mick has made before, overlapping, but also perhaps complementing and looking at some new angles on the differences between the Chinese and the US economy and what direction it's going. I think it's good. I'm coming after Mick as a graduate of Sussex University. He's still down there. Of course, he's not teaching me because I was not there. Well, probably in the 19th century was the last time I was there. However, let me share some graphs like everybody else. Let me just get that on the slideshow. Oh, I haven't done that. Hold on. Do the share. There we go. All right. That's the title of our session in short. And let's start off. We're going to give you a series of categories, economic categories, similar to Mick. His is much more comprehensive, but perhaps I've got some more other ones that we can look at and consider. The one that most people start with and in the media is the size of GDP between China and the US. Who's winning on this? Well, if you measure it on the IMF and World Bank purchasing power parity level, already China is the largest economy in the world. You can see that it crossed over in about 2016, 2017 on the basis of that measure in dollars of billions. And if it continues at current rates of growth between the two countries, as Mick said, then it will be way ahead of the US by the time we get even into the middle of this decade. But I don't think that's a very accurate way of looking at it. I think we should look at the relationship between China and US GDP terms in terms of market exchange rates, because that's where international trade, investment and so on is really measured. And if we look at it in terms of dollar market exchange rates, then we can see that the US is still ahead. So you could say the US is still winning, but you can see the gap is dramatically closing between the US and China on a market dollar basis. If you go back to 1980, the US GDP on that measure was 16 times larger than China, and now it was 30% larger at the end of these second decade of this century. And as we get to 2026, the gap will continue to narrow. Similar points, I think, that Mick has already made in this position. So shortly, by the end of this decade, if not earlier, China is likely to be the largest economy in GDP terms in the world. And as Mick has pointed out, the growth rates, if we take from post-COVID, also show the dramatic advantage that China has got over the US. In the period 2019 to 2021, which is the COVID period, if you like, Chinese growth was just over 10% over those 2 years. The growth of the US was just 2%. So the average growth per year, 5% plus in China during a COVID slump. And in the case of the US, barely 1%. And of course, that was all in 2021, the recovery. And only the US, amongst the G7 economies, has actually managed to get above the level of GDP that they had in 2019 in real terms. All the others are still below. And then if we look at general forecasts being made by international agencies about growth in China and the US on the right-hand side, you can see over the next 5 years, China is expected to continue to grow at around about 5%, which means nearly 30% increase in real GDP over the next 5 years, while the US, which is one of the better economies amongst the capitalist West, is going to be growing at less than 2% a year, or just 13% in the next 5 years. So that's why the gap is closing all the time. That's why the faster pace of GDP growth exists in China rather than in the US. Of course, that's total GDP, and with a population of 1.4 billion in China compared to about 350 million in the US, you could say, well, that's not a fair comparison because the GDP population of China is so great that it drives up GDP to such high levels. So if we look at GDP per person compared, we still see a massive increase in GDP per person in China. This is the Chinese rate of GDP per capita relative to the US. And you can see as we just entered the COVID period, it had gone up to nearly 25% of the US, but still only 25% of the per capita GDP of the US, 1/4. So there's still a fair way to go if you want to talk about China winning in the sense of having, if you like, GDP per capita as a sort of crude measure of living standards on average between China and the US. How long would it take to catch up? How long would it take for China to reach the point where it was actually winning on a per capita basis? Assuming the growth rates that we've talked about for per capita income previously and what is likely to happen over the next few decades, it would take basically to the end of the 2060 to reach 100% of US per capita income. Most G7 countries are around about 80% of this. And so if you got even up to the G7 level, we're talking about another 30 years on the current rate, despite the very fast growth of the Chinese economy compared to the US economy. So there is still some way to go before you could talk about China reaching the living standards and conditions of a modern advanced capitalist economy at the moment for its very huge population. But there are other measures of what matters in the world for humanity rather than just GDP. One of the most important ones, it seems to me, for humanity is how long you live and life expectancy at birth. If you can see this orange line here is China's. Back in 1980, the average person born in China was likely to live just 45 years. That has been dramatically transformed to 75 years here as we before the beginning of COVID. What was happening in the US, that's the top line here. You can see that it was 70 years back in 1960, way, way higher than China's. But now in 2020, 2019, it's risen to just about 77 years. And in fact, if you look very closely, you can see there's been a decline in the last few years. During the last decade, life expectancy in the US is falling as a result of some of the things that Mix has mentioned and the inequities and changes that have taken place, rising inequality, rising very high poverty in capitalist economies in the US and so on, the extremes of income and wealth, and all the other health problems that exist in that US economy. So I like to look a bit wider. If we look at the World Bank's Human Development Index trends, which I think will offer us some useful guidance. The Human Development Index trends are measured at the bottom here. This is the World Bank's attempt at key dimensions of human development: a long and healthy life, being knowledgeable, having a decent standard of living. They index this in whatever mythical way you want to do, but let's just take their figures, even if you find them perhaps a little weird. But if we look at them, we can see that the US in 1990 scored 86.5, 0.865, compared to China really on just 0.5, a huge gap between those two economies. But by the time we get to just before COVID, the US is now on 0.926, so apparently human development has improved in the US in that period of 30 years, just by 7% on this index, while China has gone from 0.5 to 0.76. It's a 50% plus increase in the Human Development Index as set by the World Bank. Nobody can compete with that movement upwards. And now China at 0.76 is higher than the world average, and it's not so far behind the position of the OECD countries. It's closing the gap with the OECD, which is on 0.9. It's way, way ahead of India, which it was fairly close to before, and it just overtaken nearly now Brazil and other countries which had much higher levels of human development back in 1990. So even on that measure, we can see a dramatic improvement and the gap closing for China across the world against other countries. What's going on? Let me get this right. Yeah, so one of the big issues figures that's always raised is the level of poverty that exists in various global South economies. And as we know, anybody who's looked at the data or considered the media, even they have to admit it, there's been a dramatic reduction in the level of poverty in the Chinese economy amongst the Chinese population over the last 30 or 40 years. The World Bank has different poverty levels. I've chosen a slightly higher one than their ridiculously low $1.9 a day as a poverty level. If you take the level of $5.50 a day, still rather pathetically low, we can see that amongst emerging economies, China has only 30% of its population living at below $5.50 a day. Way, way lower than peer global South economies that I've listed here. That compares to just 2% in the US, but this level of $5.50, of course, is a very low level indeed when it comes to the advanced capitalist countries, so they don't really score on this poverty rate. But when you're looking at the situation, we estimated something between 900 million Chinese have moved out of the level of poverty as set by the World Bank during this period. Unprecedented in the history of humanity, I think, in that sense. But is it going to continue to close the gap with the United States and the advanced capitalist countries or not? If you look at these quotes on the left-hand side, this is what some important capitalist strategists claimed in the last decade. Robert Zoellick, former World Bank chief, said, as China leaders know, the country's current growth model is unsustainable. That's what he said in 2012. Here we are nearly 10 years later. George Magnus, the well-known investment fund manager who spends a lot of time critiquing the Chinese economy, said that China's government will stifle incentives and innovation and make it even more difficult to generate productivity growth that all high middle-income countries need to avoid the middle-income trap. He said that in 2018. Mick Dunford has just shown us that actually it's about to lead the middle-income trap as set by the World Bank. Perhaps a more realistic position is to look at Arthur Kroger, head of research at Gabakal, which is in China. Is China fading? In a word, no. China's economy is in good shape, and policymakers are exploiting this strength to tackle structural issues like financial leverage, internet regulation, and the desire to make technology the driver of investment. But one of the big issues that's raised is that China is running out of people. Mick has pointed out there's still a lot of rural workers that are being urbanized and brought into the new industries that China is developing. But the total number of employed people does appear now to be falling, and falling from a peak just about at the beginning of this particular decade, and we're heading downwards, if rather slowly at the moment. So there's two ways in which growth of GDP can take place: is more people producing more, and those people producing more per person. If the number of people is going to decline, then you need to increase the productivity of that labor force. It's a simple arithmetical thing, but what's involved in the actual process is more important. On the right-hand graph, you can see that actually China averages something like 4.5% to 5% productivity growth over the period of the last 30 years, compared to the advanced capitalist countries, which are under 2% per year and eventually zero when we come into the period of COVID or just before. So what that tells me, if that continues at the moment, that gap, then labour productivity growth of 4 or 5% in China, even if the employed workforce declines a little, will continue to outstrip the growth in the advanced capitalist countries and continue to maintain probably at least something like 5% real GDP growth over the next period. And what does that mean? That means it also means if the drive is there with a drive of more productivity, then you're going to get the drive up in wages and living conditions for the bulk of the population on average across the board. Productivity and real wages are usually quite closely connected, even if there's an attempt to hold real wages down while productivity grows by capitalist governments and economies. And here we can see, just in the period of the decade before COVID, China's productivity rose by 73% in that decade, and real wages rose by nearly 70% as well. That is absolutely staggering, contrary to the view that in some way the gains of productivity and production in the Chinese economy do not spread down to the average Chinese worker, urban worker at least. In India, we've seen quite a large change in productivity too, 46%, and wages also matching that, but still way short compared to China. But if we look at the advanced capitalist countries, the UK and the US, it is totally pathetic. Productivity in the UK, in the last decade, just 3.5%, wages up by 7% over 10 years. Actually, it's the slowest growth in real wages in the history of British capitalism in the last 10, 20 years even. The US, only a little better, 11%, and just a tiny 11% in real wage growth. That's approximately less than 1% a year in real wage growth. And some of the peers of the emerging economies, India, apart from India, Russia, South Africa, and Brazil, in a terrible state when it comes to looking at productivity and real wages. Trade and technology is key for the next couple of decades, and China maintains a huge share of manufacturing, which the top left graph shows, 30% compared to the other major manufacturers in the world. Its other manufacturers rely on Chinese imports to carry out their manufacturing. German cars aren't built without Chinese imports, and so we can see the huge import content required by German manufacturing from China, as opposed to other countries like the US and Japan. The similar situation, even higher in the case of US manufacturing reliance upon Chinese imports, and Chinese reliance on US, Japanese, and German imports as a relative to their manufacturing output and exports continues to decline. So in a way, China has maintained that independence through world trade, despite the huge integration and globalization that's taken place over the last 20 years. Here is a graph I just wanted to present because it's often claimed that China is already an imperialist country. But I've done some research with Guillermo Carcedi recently, which shows that if we look at the transfer of surplus value, profit, if you like, through the process of international exchange, countries, the rich monopoly, high technology countries extract surplus value out of the poorer global south, less technology countries. In the case of China, which is obviously more technology developed than many other global south economies, nevertheless, because of the US and the other imperialist powers' monopoly position on technology and also on their position they try to control, they are extracting in surplus value in trade with China something like 5 to 10% a year of GDP out of the process of international trade between China and the advanced capitalist countries. That tells me that China is not the great imperialist exploiter some claim, quite the opposite. It remains like many other global south economies facing the extraction and exploitation by the imperialist bloc. But having said that's economics data, what about other factors which affect China? And they are, you can see, this is Tony Norfield's World Power Ranking to give us an idea of which countries are dominant in the world. Obviously, on his measure, the US is at 90, and that includes military spending, international banking, foreign assets, and control of the currencies. and of course GDP. When we look at China's share is second, apparently, at 38, but most of that is due to GDP, its control of its own foreign assets, and its banking control, but it really doesn't have military power against the US. We know that the US military spending is greater than the whole of the rest of the world put together, its military spending. And that's where the US maintains its winning position on its ability to apply military force or the threat of military force, its ability to cut off financial assets and flows to countries, particularly the countries of the third world, if countries step out of line, as we're seeing in the current dispute in Ukraine. Just want to make a couple of other points quickly. Internal contradictions exist in China. I think we ought to say inequality is great, as Mick showed as well. But this is inequality of wealth. As you can see, it's very high in all countries, inequality of wealth, ownership of property, assets, financial assets, and so on. It's around 70 on the Gini coefficient in China, which looks very high, higher than Italy and France. But look at Brazil at 89 or the US at 86. They're way, way more unequal. If we look at the wealth share of the top 1%, Brazil at nearly 50%, the US at 35, China is high, but it's still lower than those countries and lower than many other countries. Yes, the rich are getting richer in China too. And that is one of the things that Mick was bringing out. Billionaire wealth, the percentage of GDP, has rocketed in places like Russia, Sweden, and so on, but also in China, which is now around 15% of GDP, billionaires. That compares to Russia's nearly 40% of GDP, where the crony capitalists live. And as the quote on the right says, from Xi, that we cannot continue to compare this wealth gap to become an unbridgeable gulf. And we cannot afford to wait to do something about it. And Mick was mentioning some of the things that was attempted to do. I just like this quote from Xi. Last summer, he said, the Soviet Union was the first socialist country, enjoyed a spectacular success, but it collapsed, mainly because the Communist Party, the Soviet Union, became detached from the people and turned into a group of privileged bureaucrats concerned only with protecting their interests. If a governing party turns its back on the people, it will imperil the fruits of modernization. So that's the warning that China's leader is giving. Whether they can deliver that remains to be seen. On the other hand, you can take another option for China, that of Jack Ma, where he says Chinese consumption is not driven by the government, but by entrepreneurship and the market. In the past 20 years, the government was so strong. Now they're getting weaker. This he said in 2019. It's our opportunity. It's our showtime to see how the market economy, entrepreneurship can develop real consumption. So there are the two views about what direction China should go and the contradiction which exists. So the US is still ahead, but the gap is closing. The US is way ahead on GDP, and the gap won't close for decades. But China's growth rate is triple the pace of the US. COVID deaths, China 3 per million, the US 2,600 per million. That's the result of the COVID battle. Life expectancy, nearly the same. Human development, China closing the gap. Employment growth, China has no growth, maybe in employment, but the US is not much better. Productivity, China 4 times, if not 5 times faster in the past period. Wage growth, 7 times faster than US wage growth. Poverty, yes, China still has much more poverty, at least on the World Bank measure, than the US, but it's done the best of all the global South economies. Equality of wealth, high, but less than the US. Billionaires, high, but less than the US. Global power, still relatively weak compared to the US. That last one is why we have this battle in the 21st century ahead of us. The US misses to maintain its global power, even though it's losing ground on all these other factors.